Amundi, the largest asset manager in Europe, quietly rebalanced $2.4 trillion away from US dollar exposure. No press conference, no televised announcement, just a line in a strategy note that most people will never read. And if you earn in dollars, save in dollars, or plan to retire in dollars, this changes everything. What if everything you believed about the safety of the world's reserve currency was built on an assumption that is now expiring? This unfolds in 4 stages. Stage 1 is confidence. Capital flows toward the dominant currency because trade, energy, and debt are priced in it. The system feels permanent because it has lasted longer than most careers. Stage 2 is substitution. Large institutions begin to hedge quietly. Not out of panic, but out of mathematics. Stage 3 is recognition. Governments and corporations notice the shift and follow it to protect balance sheets. Stage 4 is acceleration. The move that began as optimization becomes a structural break. This isn't prediction. This is pattern recognition from 300 years of monetary history. In 1914, the British pound was the unquestioned center of global finance. London cleared more than 60% of world trade, and British banks financed railways on 5 continents. But by 1925, after years of war debts and rising American industry, the Bank of England struggled to defend the gold peg. Sterling assets were sold not by enemies, but by allies. The same pattern, same stages, same outcome. Central banks did not announce a revolt against London. They simply diversified to protect reserves. By 1931, Britain abandoned gold, and the pound's dominance ended not with a speech, but with a spreadsheet. The Dutch Republic experienced the sequence 2 centuries earlier. Amsterdam once financed half of European shipping. When military costs rose and trade margins thinned, Dutch investors moved savings to London markets that offered better returns. The timeline varied, but the sequence never changed. Private decisions aggregated into a geopolitical turning point. The French livre in the 18th century tells the same story. After decades of fiscal strain, wealthy families shifted wealth into British bills and Spanish silver. No single day marked the collapse, just a slow migration of confidence. 3 empires, 3 currencies, 300 years, identical 4-stage cycle. Now return to the present day. Amundi manages more than $2 trillion for pension funds, insurers, and sovereign institutions. These are not speculators chasing headlines. They are the custodians of European retirement systems. When such a manager reduces dollar exposure, it is not a trade. It is a signal. The stated reason was valuation risk and geopolitical fragmentation. The unstated reason is arithmetic. U.S. federal debt has crossed levels that historically pressured every reserve currency before it. Interest payments consume a rising share of tax revenue. If you are 30 years old saving for retirement, this affects the real value of every paycheck you set aside. Some will say this time is different. Here's why it's not. The dollar's strength rests on 3 pillars: energy pricing, military alliances, and the depth of treasury markets. Each pillar is now under quiet stress. Major exporters are settling more contracts in regional currencies. Defense partners are questioning automatic alignment, and treasury buyers are demanding higher yields to compensate for inflation risk. None of this is ideological. It is balance sheet logic. Asset managers must protect purchasing power measured not in headlines, but in decades. Consider what a $2.4 trillion reallocation actually means. It means selling a portion of dollar bonds and equities and buying alternatives in euros, Asian currencies, and real assets. Every sale requires a buyer. If fewer institutions want long-dated treasuries, yields rise. Higher yields feed directly into mortgage rates, business loans, and government interest costs. The mechanism is mechanical, not emotional. For the ordinary household, the transmission is immediate. A family seeking a home loan faces payments set by global portfolio decisions made in Paris and Frankfurt. A small business refinancing equipment pays interest determined by how European pensions view American risk. Currency shifts are not abstract. They arrive as higher grocery bills and thinner savings. Supporters of the dollar point to its unrivaled liquidity. They are correct. But liquidity attracts capital only while returns compensate for risk. If inflation persists above target, the real yield of dollar assets turns negative. Large managers do not debate patriotism, they compare spreadsheets. Amundi's note emphasized diversification, not abandonment. That language mirrors every previous transition. No institution announces the end of an era while it is still unfolding. They simply adjust weights month by month. By the time the public recognizes the pattern, portfolios have already moved. The United States still benefits from the network effect of decades. Oil contracts, airline leases, and technology supply chains remain dollar-denominated. But networks weaken at the edges first. The shift begins in percentages too small for headlines and too large to ignore over time. Stage 2 of the cycle is where we stand. Institutions hedge exposure while maintaining public confidence. The risk is not collapse tomorrow. The risk is erosion over a decade. Purchasing power can disappear without a single dramatic event. Look at the composition of global reserves. The dollar share has been declining gradually while gold and regional currencies gain modest ground. Each movement is justified as prudence, not rebellion, yet prudence accumulates into transformation. History shows that reserve status ends when three conditions align. First, the issuer's debt grows faster than its productive capacity. Second, alternative financial centers mature enough to absorb flows. Third, major holders decide the risk premium is insufficient. All three are visible today. What happens over the next 12 to 24 months will not be a crash but a negotiation. Governments will encourage domestic investors to hold more local assets. Corporations will match revenues with liabilities in the same currency. These steps reduce dependence without public confrontation. For households, the rational response is clarity, not fear. Savings concentrated in a single currency assume that currency's stability. Diversification once meant stocks and bonds. Now it also means geography and denomination. The principle is older than markets themselves. Do not tie your future to one promise. None of this predicts the end of America's economy. Nations remain innovative long after their currencies lose privilege. Britain remained prosperous after sterling faded, yet savers who ignored the shift paid a silent tax through devaluation. The lesson is preparation based on precedent. Watch three signals in the coming year. First, whether additional European managers follow Amundi's lead. Second, the share of new trade contracts settled outside dollars. Third, demand at U.S. Treasury auctions relative to supply. These indicators reveal the stage of the cycle more honestly than speeches. If you are building a retirement account, this matters because your horizon spans decades, not election cycles. The real question is not loyalty to a flag, but preservation of purchasing power. History rewards those who read patterns instead of promises. The movement of $2.4 trillion was not dramatic theater. It was a cautious calculation by professionals who must pay pensions in 2045 and 2055. Their responsibility is to tomorrow's retirees, not to yesterday's assumptions. That responsibility is now reshaping the monetary map. You have a choice. Understand the pattern and position accordingly, or ignore it and hope this time is different. Every generation believes it lives outside history until history proves otherwise. But remember, this time is never different. The pattern is absolute. If this analysis opened your eyes, subscribe now. In the next investigation, I will show how central banks are preparing parallel payment systems that could accelerate this shift. The currency cycle is moving. The only question is whether you'll see it before it arrives.